EQT Corporation Stock Target Price Forecast and Full Valuation Analysis, May 2026, by Value and Momentum Portfolio. Welcome back. Today we are taking apart one of the most misunderstood stories in the U.S. energy sector. The ticker is EQT. Most people on the street still see it as a gas driller. We think that framing is already 2 years out of date. Here is the picture. EQT trades at $57.92. Market cap is $36.2 billion. Enterprise value sits at $45.4 billion. The 52-week range runs from $48.48 on the low end up to $68.24 on the high end. So we are roughly in the middle of the range in a quiet consolidation. Underneath that quiet tape, 3 structural shifts are running at the same time. First, a CapEx inflection. Maintenance spend drops by roughly $750 million between 2026 and 2028. That cash drops straight to free cash flow with no help from revenue growth. Second, a balance sheet that has been rebuilt at a pace nobody really expected. Net debt has fallen from $8.2 billion in Q3 2025 to about $5.7 billion post Q1 2026. The $5.0 billion long-term target is now 1 or 2 quarters away. Third, the LNG and data center demand stories are about to get their first real contractual proof points in the back half of 2026. So the question driving this entire episode is simple. At $57.92, is this a compounder you should own, or is the upside already in the tape? Let us walk through it. What EQT actually is today. EQT was founded in Pittsburgh in 1888. It used to be called Equitable Resources. The name changed in February 2009. Today, it is the largest natural gas producer in the United States. That headline tells you almost nothing. The real story is the integration. EQT controls roughly 2,945 miles of pipeline. It owns 28.0 trillion cubic feet equivalent of proved reserves. It holds an equity interest in the Mountain Valley Pipeline running from West Virginia into Virginia, and it produces close to 10% of all natural gas in the country. After the 2024 Equitrans acquisition and the 2025 Olympus Energy bolt-on, the business is no longer a pure driller. It is a vertically integrated energy logistics platform. Production accounts for about 92% of revenue. Midstream brings in the other 8% through third-party fees, roughly $650 million. But the value of the midstream is not in that fee line. The value is in what it does to internal cost structure. Per unit operating cost is $1.09 per 1,000 cubic feet equivalent. That is dramatically below non-integrated peers. EQT achieves that by controlling the gathering, compression, and transmission infrastructure that drains its own wells. The same pipeline shield that produces a small fee line slashes the per unit cost across the whole production base. That is the trade, and that is the heart of the moat. Unit economics from Q1 2026 look like this. Average realized price before hedging, $5.27 per 1,000 cubic feet. Total operating cost, $1.09. Unhedged cash margin, roughly $4.18. That is what a low-cost manufacturing business looks like inside a commodity wrapper. Production guidance for 2026 runs 2,275 to 2,375 billion cubic feet. That is flat to slightly down from the 2,382 billion cubic feet produced in 2025. This is not a growth problem. Management is intentionally holding back 10 to 15 billion cubic feet of strategic curtailments in Q2 to maximize realized prices. Because they own the infrastructure, they can use it as synthetic storage. Smaller producers cannot do that. The moat. Let us be precise on the moat. EQT does not have a wide one. We would call it narrow but real. The source is cost leadership and scale inside the Appalachian Basin. 3 pieces hold it together. First, vertical integration. The pipeline shield protects margin during price lows that hurt non-integrated competitors. Second, combo development. EQT drills 15 to 20 wells per pad instead of the industry standard of 4 to 6. That cuts rig moves and water handling costs. Third, the Mountain Valley Pipeline. Regulatory and legal friction makes it nearly impossible to build a competing pipeline out of the basin in the next decade. EQT controls the bottleneck. That is what gives them access to premium markets in the Southeast. Operating leverage matters too. The 2024 and 2025 acquisitions added about 20% to production volume, while fixed administrative costs only rose about 7%. That gap is what shows up later when revenue scales. Now the risks. Methane fees could reach $1,500 per ton. That would turn older wells into liabilities. Expand Energy is a new rival that could undercut on price for future LNG contracts. And if AI power demand shifts faster than expected toward nuclear or long-duration storage, the gas window shrinks. EQT has built a fortress, but the political landscape for new energy infrastructure in 2026 is not friendly. Pricing power. EQT does not set the global gas price. Nobody does. What EQT controls is how much of that price it actually keeps. By owning the exit ramps out of the basin, it avoids the localized discounts that smaller producers eat. You can see this in the margin record. In the 2022 high-price environment, operating margins peaked around 55%. Then through the oversupply period of 2023 and 2024, EQT held operating margins above 30%, while many peers compressed to the 15 to 20% range. That gap is the moat showing up in the income statement. There is also a curiosity worth flagging. In March 2024, EQT actually curtailed 1 billion cubic feet per day in response to weak prices. Because they sit on close to 10% of U.S. supply, an individual production decision now creates a feedback loop in regional pricing. That is unusual for a single producer. And there is a small but growing product differentiation angle. Responsibly sourced gas, the certified low methane product, is now earning a premium of 2 to 5 cents per thousand cubic feet in certain utility and European markets. Not the main story, but worth tracking. Price action and technicals. The stock at $57.92 sits in the middle of a 52-week range of $48.48 to $68.24. It hit $68.24 back in March 2026 and has pulled back about 15% since then. Year to date, the stock is up about 18%, having started January around $49. The longer-term trend has been strong since the August 2024 lows, but recent momentum has cooled. Versus the energy sector, EQT now sits in roughly the 21st percentile on a one-year basis. That means it is underperforming about 79% of its sector right now. As recently as late February, that figure was the 34th percentile. So relative strength has slipped. Seasonality matters here too. March and April are historically the strongest months, averaging plus 6.4 and plus 10.3%. May is neutral, around plus 0.5% on average. We are now entering the seasonally weakest stretch heading into summer and fall. Operations and free cash flow. Production mix is roughly 93% natural gas and 7% NGLs and oil. So this is effectively a pure-play gas company. Q1 2026 produced a number that, frankly, jumped off the page. Free cash flow of $1.8 billion in a single quarter. To anchor that, the entire 2022 FCF was the same dollar figure. And 2022 was a year when gas averaged over $6 per million BTU. That is what vertical integration looks like when it actually clears the income statement. Some of that Q1 number was helped by $475 million of working capital inflows that were seasonal and partially one-time. Strip that out, and underlying FCF was still about $1.35 billion in the quarter. Still exceptional. On finding and development cost, EQT is at 68 cents per thousand cubic feet equivalent, against a $3 plus NYMEX environment with $2.50 to $2.80 net realization. The spread is wide. New wells generate strong returns. That F&D number is honestly the crown jewel of the operational story. On hedging, in 2024, the hedge book added 53 cents per thousand cubic feet, a lifeline in a weak market. In 2025, as spot rallied, hedges turned into a modest 5-cent drag. That was deliberate. Management was entering high-ceiling collars during price strength to preserve upside. And in Q1 2026, the design paid off. They captured nearly 100% of the price surge, near zero hedge drag in the peak quarter. Now the debt story, which is the defining theme of 2026. 18 months ago, the balance sheet was the main concern. Debt sat at $8.2 billion after the Equitrans deal. Reported leverage hit 6.19 times during a weak Q3 2025 cash flow quarter. That number scared people but was distorted by a shoulder quarter EBITDA print. Q1 2026 retired $1.7 billion of debt in 3 months. Funding was 100% internally generated cash. No equity dilution, no new issuance. Net debt is now approximately $5.7 billion, and the company is closing in on the sub-$5.0 billion target. When that number's hit, the capital return playbook unlocks. Buybacks, a growing base dividend, and the room to keep investing in midstream growth without leverage pressure. The second derivative. Here is the question that matters more than any single metric. Is EQT taking share, and on what dimension? In volume terms, no. U.S. gas production and EQT are growing at roughly the same rate. The share story is not volume, it is economics. 3 pieces drive that. First, realized price premium. MVP mainline access delivers a structural 20 to 35 cent premium per 1,000 cubic feet versus pure Appalachian spot. No basin peer has equivalent takeaway diversification. Second, cost structure. Lease operating expense is 9 cents versus basin peers at 12 to 18 cents. Third, the demand side. The real TAM expansion is not more gas production, it is new demand pools. Data center power, which management tracks at 8 to 10 billion cubic feet per day of potential capture. LNG export, coal to gas switching. Those are demand-driven gains against incumbent energy sources. Look at gross margins. EQT runs 73%. Antero is at 57%. Range Resources at 60%. That spread is a Moat indicator. And it is expanding, up 5 points from 68% in 2021. The rare combination of pricing power and scale efficiency. This is a widening moat, not a narrowing one. The 3-layer inflection is worth repeating because most street models miss the back half of it. Layer 1, CapEx peak to free cash flow, harvest from 2026 to 2027. The $750 million CapEx decline drops to FCF at flat gas prices. Layer 2, ROIC compounding on a shrinking invested capital base from 2027 to 2030. As net debt falls from $5.7 billion toward $2 billion, IC shrinks while NOPAT grows. ROIC moves from 14% today toward 22% by 2030. The economic profit spread widens from plus 3.3% today to plus 10.6%. Layer 3 LNG monetization in 2029 and 2030. Management has said it plainly. If the LNG portfolio were fully online today, projected 2026 FCF would be approximately $6 billion. That is an incremental $2.75 billion of FCF on top of base. Discount that LNG stream back 4 years at an 11.2% WACC. Present value of that incremental stream is roughly $8 to $10 billion of unpriced NPV. On 625 million shares, that works out to about $13 to $16 per share of embedded LNG optionality. The consensus is pricing this at 0. The valuation case. Let us tie the methods together. Universal assumptions. Risk-free rate of 4.40%, the 10-year Treasury, equity risk premium of 5.50%, beta of 1.45, CAPM required return of 12.4%, WACC of 11.2%, current price $57.92, current EV $41.9 billion. On trading multiples, EV to EBITDA is the right primary lens. The Equitrans acquisition added over $10 billion of property, plant, and equipment, which generates $2.0 to $2.5 billion of annual D&A. GAAP net income massively understates economic earnings. EBITDA cleans that up. EQT trades at 9.8 times EV to EBITDA. That is a 58% premium to the peer group median. Some of that premium is earned. EQT is the only U.S. gas producer with 4.5 million tons per annum of contracted LNG offtake starting in 2029. The MVP integration creates better realized prices than any other basin producer. The company is 3 times the size of its nearest regional peer, which earns a liquidity premium. And the $750 million CapEx release in 2027 should re-rate FCF. But part of that premium needs validation. NTM growth of plus 8% is the slowest in the peer group. Cash flow generation for the next few years will look a lot like cheaper peers. At 9.8 times, the market is already pricing in partial LNG materialization. Management has to execute cleanly to defend the multiple. The regression work is interesting. Using the 3 pure Appalachian peers as the fitting universe, the model says EQT's 9.8 times EV to EBITDA contains roughly 4.1 turns of moat and optionality premium above what pure E&P fundamentals justify. The model is not saying the stock should trade at $30. It is saying the market is currently pricing in roughly a 25% LNG success probability. If that probability moves to 50%, the stock re-rates to $70 to $79. On NTM-FCF yield, EQT is at 8.43% against a 12.38% CAPM hurdle. At face value, that says the stock is not cheap on near-term cash. That is correct, but it is the wrong frame. This is a business mid-transition from CapEx peak to harvest. What is the market actually pricing in? Reverse-DCF is where this gets interesting. Hold WACC at 11.2%. Hold terminal growth at 2.0%. Solve backward from the current $41.9 billion EV. The implied revenue CAGR is 8.5%. That sits just below the company's 5-year organic history of 8 to 10%. So growth assumptions are not aggressive. Implied FCF margin is 37%. Our models show that margin reaching 39 to 47% by the 2028 to 2030 period. So margin assumptions are conservative. The Reverse-DCF terminal FCF is $4.385 billion. Our base model without LNG gets to $4.59 billion. The market is pricing in less than the base case before LNG. On CapEx, the implied levels are only reachable if spending steps down exactly as management has guided. No buffer for error? The clean read. The market is mildly pessimistic. Investors want proof of execution before they pay for delivery. That creates a variant perception opportunity. EQT does not need to outperform. It just needs to execute the stated plan. And if it does, the LNG upside, which carries a net present value of more than $37 per share by our work, is effectively free at the current entry point. Sum of the parts. 3 reportable segments: upstream, gathering, transmission, plus the MVP joint venture equity stakes across Series A, B, and C, plus the LNG portfolio at 6.5 million tons per annum of total exposure with commencement in 2030 and 2031. A methodological note. Upstream is valued net of intercompany gathering and transmission fees. Those fees are captured in the gathering and transmission standalone values. Otherwise, you double count, which is the most common error in E&P SOTP work. The base case SOTP intrinsic value lands at $84.83 per share. Against $57.92, that is a 37% discount. The market currently applies a single blended 6.6 times EV to EBITDA multiple to 3 fundamentally distinct assets: upstream production, MVP infrastructure, LNG optionality. When you break them out and multiply them properly, the conglomerate discount looks structurally unjustified. The pipeline infrastructure alone should produce about $2.5 billion in annual EBITDA at maturity. That alone deserves a midstream multiple, not an E&P multiple. Monte Carlo simulation and margin of safety. On the simulation, the historical volatility anchor is EQT's 5-year realized annualized volatility of 33.7%, taken from 260 weekly closes. 4 stochastic variables: revenue CAGR, FCF margin, exit multiple, and WACC. The intervariable correlations matter. A high gas price environment lifts revenue, lifts FCF margin, lifts the exit multiple. WACC rises with inflation, which partially offsets. Modeling correlations cuts tail severity by about 18% versus naive independent sampling. The margin of safety framework is clean. Probability-weighted intrinsic value is entirely a function of how much LNG execution probability you assign. 0% and the stock looks slightly overvalued. 25 to 30% and it is fair to modestly undervalued. 50% or more and the margin of safety becomes significant. That is the entire risk-reward in one sentence. The accumulation zone we would target is $44 to $47 per share. That is 8 to 24% below current. At that zone, FCF yield exceeds 13.6 to 14.5%. Above every Appalachian peer, base case IRR of at least 15%, SOTP discount around 47 to 50%, and there is recent chart support. The stock bounced from $46.15 in late March to 2026. A 20% IRR is a different conversation. That essentially requires perfect conditions: flawless LNG ramp, materially higher gas prices, aggressive buyback execution. We treat that as a P95 outcome, not a base case. What the street sees. Sentiment is constructive. Since January 2026, there have been 18 ratings published. 16 buys, 2 holds, 0 sells. Price targets cluster between $69 and $79 versus the $57.92 spot. That implies 20 to 35% upside on consensus. A couple of specific calls. Truist came out in March with a buy rating and a $74 target. Wells Fargo went to $79, which is the high mark on the street right now. The analyst consensus average target sits around $69.50 to $70.50, depending on how you average. Catalysts to watch. There are 3 buckets of catalysts worth focusing on. First, data center demand. Hyperscalers in the Mid-Atlantic corridor are facing grid delays of 4 to 7 years to power AI facilities. EQT is in early discussions to supply gas directly from the wellhead for on-site power. If they bypass the electric grid, EQT could charge a reliability premium of 50 cents to $1 per 1,000 cubic feet over local prices. Capture just 1.0 billion cubic feet per day of that demand by 2028, and you add somewhere between $180 million and $360 million to annual free cash flow. Second, MVP capacity expansion. The market treats MVP as a static asset capped at 2.0 billion cubic feet per day. Engineering specs suggest additional compression stations could add another 25% to capacity. That is roughly 0.5 billion cubic feet per day of high-margin, fee-based volume. Estimated $120 million in near-term EBITDA. Third, cost trajectory and capital return. Consensus assumes operating cost floor at 1.05 to 1.10 per 1,000 cubic feet equivalent. Our view is the company breaks below $1 by year-end 2026, helped by eliminating third-party gathering fees and optimizing water recycling through Olympus. And as net debt clears the $5 billion mark, which we expect by Q3 2026, the $2 billion buyback authorization should become the primary use of cash. On hard catalysts, 3 to 6 months out, we expect non-core asset sales. Consensus is looking for $500 million to $1 billion of proceeds. We see a path to a surprise deal worth $1.5 billion or more, which could pull the net debt target forward by 2 quarters. 6 to 9 months out, LNG export permitting is in play. Most investors expect a slow grind, but legal or legislative breakthroughs on terminals like CP2 could unlock 15-year supply deals that are currently stalled. And the Q3 2026 earnings print, roughly 5 months away, may bring an updated shareholder return framework with faster buybacks. What would kill the thesis? Run a pre-mortem. Fast forward to May 2029. The stock is down 60% to $23.15. What happened? The failure is not falling gas prices. The failure is what we would call an idiosyncratic integration trap. The midstream that was sold as a cost-saving moat becomes a fixed-cost anchor. Maintenance capital on the 2,945 miles of pipeline runs 40% above our estimates. At the same time, the data center pivot turns out to be a miscalculation. Hyperscalers move towards small modular reactors and behind-the-meter nuclear to satisfy carbon-neutral mandates. They bypass responsibly sourced gas entirely. MVP becomes a stranded asset if secondary litigation blocks Southeast delivery points. EQT becomes a bloated utility with high fixed costs into shrinking demand. To avoid being late to that scenario, we watch three markers. First, unit operating costs. If they rise above $1.18 per thousand cubic feet equivalent, the cost moat is cracking. Second, leverage. If net debt to EBITDAX stays above 2.5 times, the credit re-rating dies. Third, maintenance CapEx. It needs to stay below $2.2 billion per year to keep the cash flow yield competitive. We also monitor weekly MVP flow data and regional grid interconnection queues to see if nuclear projects are moving faster than gas-fired plants. And any material selling by the Rice brothers or senior engineers would signal internal skepticism about the integration. None of those flags are flashing today. Bottom line. Pull it all together. The stock is at $57.92. 52-week range, $48.48 to $68.24. Market cap, $36.2 billion. Net debt now down to about $4.6 billion by the latest read, depending on which post-Q1 cut you use. Our rating is overweight with a 65 out of 100 conviction score. 12-month price target, $72, implying about 24% upside. We do not see EQT as a gas producer. We see a mispriced infrastructure platform. At today's price, it trades at a 37% discount to SOTP intrinsic value of $84.83. The LNG call option is the asymmetric part. 6.5 million tons per annum of contracted or near-contracted export capacity ramps between 2029 and 2031. That is approximately $4.3 billion in potential incremental annual free cash flow. The current share price assigns $0 to that. Investors are essentially being paid to wait. Data center demand is the bridge. Power for AI hyperscalers is creating a multi-decade shift in U.S. gas consumption. Management has guided that new contracts may be announced in the second half of 2026. Long-term fixed-price PPAs would convert volatile production cash flows into stable annuities. Those annuity-like cash flows could earn a 12 to 14 times multiple instead of the 6.6 times EQT trades at today. Balance sheet trajectory remains the unsung tailwind. Net debt has fallen from $8.2 billion in Q3 2025 to approximately $4.6 billion by Q1 2026, a $3.6 billion reduction in 9 months. At the current FCF run rate, EQT reaches net debt neutral by 2028. Every dollar of retired debt permanently unlocks a dollar of equity value. On the cash side, NTMFCF per share is $6.40. That is an 11.0% yield, but entering at $57.92 only delivers a 5-year baseline IRR of 8.8%, slightly below the 10% institutional hurdle. So the risk to reward is marginal at this exact price, around 1.01 to 1. We prefer to phase in within $48 to $54. At a $50 entry, the risk to reward shifts to roughly 3.7 to 1, and the 5-year IRR moves to about 14%. Our bear case pre-mortem target is $36, and we use a hard stop loss at $44. A weekly close below $44 would invalidate the thesis. The single most important near-term event is data center contract announcements. Those could add $10 to $15 per share of value. The single most important long-term event is LNG monetization between 2029 in 2031. Those two events sit on top of a mechanical free cash flow harvest that begins immediately as CapEx normalizes. The street still sees a gas driller. We see a logistics platform with the gas exposure embedded inside it. The market is paying for the driller and getting the platform for free. That is the trade. That is the full breakdown on EQT Corporation. If you found this useful, subscribe to the Value and Momentum portfolio for the weekly macro and market pulse and our high conviction setups. We will be tracking EQT through the Q3 2026 print, the data center contract news, and the next leg of the net debt paydown. This report is for informational purposes only and does not constitute financial advice. Please conduct your own due diligence. Thanks for listening, and we will see you on the next one.